All right, I'm within escrow requirements under RESPA in the reference guide to regulatory compliance. Coverage of escrow requirements is any account established or controlled by a servicer on behalf of a borrower to pay taxes, insurance premiums, or other charges with respect to a federally related mortgage loan. Accounts under the total control of the borrower are not included. Analysis of escrow account is done twice, at the establishment of the account and annually. The lender must conduct an escrow account analysis before establishing the account to determine how much the borrower must deposit into the account and the periodic escrow payments due. And the annual account analysis is performed by the lender to at the completion of the escrow account computation year to determine monthly escrow payments for the following year. The initial escrow account statement is sent by the lender to the borrower either at settlement or within 45 days of settlement. This statement must contain the amount of the borrower's monthly mortgage payment and the portion of the monthly payment going into the escrow account. An itemized list of expected disbursements of taxes, insurance, and so forth from the escrow account during the year. So it's scheduled and looks kind of like an amortization schedule, and it will include those expected disbursements and the anticipated disbursement dates of charges, meaning I actually don't know what that means, so I'm not sure if it's showing your monthly mortgage payment and how it's broken down, and then the disbursements. Throughout the year, and the amount the servicer selects as a cushion and a trial running balance of the account. The escrow account statement is provided by the lender annually and within 30 days of the completion of the escrow account computation year. This requirement does not apply if the borrower is more than 30 days past due, the servicer has brought an action for foreclosure, or the borrower has filed for bankruptcy. If the account is later reinstated, however, the servicer must provide a statement with the history of the account since the last annual statement within 90 days of the account becoming current. The escrow account statement, that is, must contain the amount of the current mortgage payment and the amount going into the escrow account, the amount of the past year's monthly mortgage payment, and the portion that went into the escrow account, the total amount paid to the escrow account during the computation year, and the total amount paid out of the account during the past computational year. The balance in the account at the end of the period, and an explanation of how any surplus is handled. Further, an explanation of how any shortage or deficiency is to be paid by the borrower, and if applicable, the reasons why the estimated low monthly balance was not reached. Short year statements. If the borrower pays off a loan during the escrow account computation year, the servicer must submit a short year statement to the borrower within 60 days after receiving the payoff funds. Limitations on payments to the account. Lenders may require that only the following payments be deposited into escrow accounts, and that would be at the establishment of the account or settlement, an amount sufficient to pay the charges respecting the mortgage property that are attributable to a period from the date such payments were last made until the initial payment date. During the life of the escrow account, a monthly sum equal to 1/12 of the total annual escrow payments that the servicer reasonably anticipates paying from the account. Servicers are not required to use a cushion. If a cushion is required in the escrow account, the maximum can be no greater than 1/6 of the estimated total annual payments from the account. However, the loan servicer must examine the loan documents, and if a lesser cushion is required, the servicer must abide by that limitation. Additional deposits to make up a shortage or eliminate a deficiency in the escrow account, and practicing pre-accrual is not permitted. I'm actually rather interested in this now because if you're refinancing with the same, no, let's not use a refinancing example. If you're refinancing with a different borrower, a different mortgager, and you're refinancing right when like a month or two before school taxes are due, then what this, I believe, is saying is that you're not going to be able to pre-accrue. You're not going to be able to collect that amount at the time of the closing. So additional deposits to make up a shortage or eliminate a deficiency in the escrow account, right, that can be done annually. But at establishment of the account or settlement, an amount sufficient to pay charges respecting the mortgaged property that are attributable to the period from the date such payments were last made until the initial payment date. So let me just reread that. Lenders may require that only the following payments be deposited into the escrow accounts, and that is at the establishment of the account or settlement, an amount sufficient to pay the charges respecting the mortgaged property that are attributable to the period from the date such payments were last made until the initial payment date. I just don't see, and if it says here later on that practicing pre-accrual is not permitted, then I don't know what you would need to do. You would need to pay it at closing, like pay the taxes early. I don't know, but the last part here says if loan documents allow for greater payments to the escrow account than allowed by Reg X, then the limits of Reg X apply. Payments from the account. The lender must make payments from the escrow account in a timely manner. The lender must make payments on or before the deadline to avoid a penalty, provided the borrower's payment is not more than 30 days overdue. If the taxing authority offers no discounts for disbursements on the lump sum basis and does not impose any penalties for installment payments, the servicer may make payments either way. The Bureau encourages servicers to comply with the borrower's preference. Lenders or servicers are allowed to obtain disbursement preference agreements from borrowers before settlement. Payment of hazard insurance. The timely payment is required. A servicer may not purchase force-placed insurance for a loan where the mortgage payment is more than 30 days overdue, but which has an established escrow account for the payment of hazard insurance unless the servicer is unable to disburse funds from the escrow account to timely make the insurance payment. A servicer is unable to disburse funds to pay a borrower's hazard insurance premium only if the servicer has a reasonable basis to believe that either that the insurance has been canceled for reasons other than non-payment of premium charges, or that the property is vacant. The ability to disburse funds, this is still within the payment of hazard insurance. A servicer is not considered to be unable to disburse funds from the borrower's escrow account because the account contains insufficient funds. If the servicer advances funds to an escrow account to ensure that hazard insurance funds are paid in a timely manner, the servicer may seek repayment from the borrower for the funds advanced. For the small servicer rule, that servicers that service less than 5,000 mortgages may purchase force-placed insurance and charge the borrower, provided that the cost of the insurance is less than the amount the servicer would have to advance to pay hazard insurance. Other requirements, accounting requirements. aggregate account analysis. The lender must analyze the sufficiency of funds in the escrow account as a whole rather than on a single premium. When calculating the escrow account analysis on the federally related mortgage loans, the lender must use aggregate account analysis. Surpluses. If, after conducting an analysis, a surplus of at least $50 exists in an escrow account, the lender must refund the amount to the borrower. If the surplus is less than $50, the lender may refund it or credit it to the borrower's future payments. If the borrower's account is 30 days or more past due at the time of the escrow analysis, the surplus rules do not apply. Shortages. If an account analysis reveals a shortage of less than 1 month's escrow account payment, the servicer may allow the shortage to exist and do nothing, or allow the borrower to pay the shortage amount within 30 days or over a 12-month period in equal monthly payments. If the account analysis reveals a shortage equal to or greater than 1 month's escrow account payment, the servicer may allow the shortage to exist and do nothing, or allow the borrower to repay it within equal monthly payments over a 12-month period. Deficiencies. If the account reveals a deficiency, which is a negative balance, then the servicer may require the borrower to repay the deficiency in monthly payments. If the deficiency is less than 1 month's escrow account payment, the servicer may allow it to exist and do nothing, or require the borrower to pay it within 30 days, or allow the borrower to repay the deficiency in 2 or more equal monthly payments over a period of up to 12 months. If the deficiency is equal to or greater than 1 month's escrow account payment, the servicer may allow it or ask that it be paid in 2 or more equal monthly payments over a period of up to 12 months. If the borrower is not current in making payments at the time of the escrow analysis that reveals a deficiency, these rules do not apply, and the servicer may take action pursuant to the loan documents. Before I go into penalties, I just wanted to mention that perhaps in my question before where I said we're closing on a refinance at our bank and the taxes are going to be due in 2 months, and we're only allowed to ask 2 months up at closing, 1 month for the cushion and 1 month because that's the rule under RESPA. So we're going to be deficient in that account and cannot recover that until the annual analysis. I presume is the way that RESPA expects that one would handle such a situation. Penalties, civil money penalties of $50 for each unintentional failure to deliver initial or annual escrow account statement may be levied by the CFPB. The total penalty cannot exceed $100,000 for a 12-month period. The intentional failure, however, to give the borrower an initial or escrow letter can bring civil money penalties of $110 for each violation without limit on total amount assessed. Actual damages can be assessed for failure to follow mortgage servicing transfer requirements plus an additional amount up to $1,000 if the violation was a pattern or practice. Records retention on page 277, the HUD or HUD 1 forms and HUD 1A forms and related documents must be kept for 5 years from the date of settlement unless the lender sells the loan and does not retain servicing. Records may be retained electronically. Servicing records. Servicers must retain records that document actions taken with respect to a mortgage until 1 year after the loan is discharged or the servicing is transferred. A servicer must retain the following documents in a manner that facilitates compiling them into a servicing file within 5 days. And that includes the ability to compile into a servicing file 1, a schedule of all transactions credited and debited to the account, including any escrow account and suspense account. 2, a copy of the security instrument that establishes the lien securing the mortgage loan. 3, any notes created by servicer or personnel reflecting communications with the borrower about a mortgage loan account. And 4, if applicable, a report of the data fields relating to the borrower's loan account created by the servicer's electronic systems. And 5, copies of any information or documents provided by the borrower to the servicer in connection with the loss mitigation or error resolution process. Enforcement comes with civil liabilities and FIRA penalties. The FIRA penalties our usual, except that the penalty is up to $1.425 million per day for those parties that are knowingly committing crimes and benefiting from them. Civil liability, however, if illegal referral fees or kickbacks are taken, the bank is responsible. Individual may be liable for 3 times the fee or kickback plus court costs and attorney fees. If seller legally requires the use of a particular title company, the seller may be liable for 3 times the fee for the title policy. And for violation of the servicing requirements, both the disclosure requirement and the requirement to answer qualified inquiries, the lender or servicer may be liable for actual damages, additional damages up to $1,000 for individuals, and additional damages in class action up to $1,000 per class member. Member. Do not exceed the lesser of $500,000 or 1% of the servicer's net worth, and court costs and attorney fees. The failure to provide an annual escrow statement, creditors or servicers may be fined $50 up to $100,000 in any 12-month period. The criminal liability for kickbacks and unearned fees is up to $10,000 in an imprisonment